Imagine for a second that you own a massive, heavily polluting factory. You make heavy metals, your smokestacks are just pouring out carbon all day long.
And a real environmental nightmare.
Exactly. And because of that, it costs you an absolute fortune in environmental compliance.
Yeah.
Just to keep the lights on, you're paying millions. But then, one morning, you wake up to some incredible news.
Okay.
Because of this sudden accidental market shock, the government's environmental compliance costs are just slashed, cut by 50%, right in half, overnight.
I mean, you'd pop the champagne, right? The executives are throwing a massive party.
You would. The stock market should be throwing a parade for your company. Your costs just plummeted, so, your profit margins should theoretically just skyrocket.
Right.
But what if instead your company's stock price instantly plummets? Like, what if that massive reduction in your regulatory burden actually destroys a huge chunk of your corporate wealth in a matter of hours?
It completely defies all conventional economic intuition. It sounds impossible.
But it isn't a hypothetical scenario. It actually happened. Welcome to today's deep dive. Today, we are exploring a really mind-bending National Bureau of Economic Research working paper.
Yeah, it's titled Profiting from Regulation, an Event Study of the EU Carbon Market. The economists behind it are James B. Bushnell, Howard Chong, and Erin T. Mansur.
And our mission today is to show you how everything you thought you knew about government regulation, corporate profits, and, well, environmental policy is completely upside down.
Totally backward.
We are going to completely dismantle the assumption that environmental rules destroy corporate wealth. So buckle up.
Yeah, to really understand this paradox, we have to take you back to 2006.
Right.
The European Union had just created the world's first massive cap-and-trade system for carbon, the EU ETS. It's a market worth tens of billions of dollars.
Okay, let's unpack this for a second, because cap and trade is one of those terms you hear on the news, but the actual mechanics are wild. The government basically invented a new currency out of thin air, right? The carbon permit.
That is exactly what they did. The goal was to reduce greenhouse gases. So they capped total emissions and then let companies trade the rights to pollute.
Meaning, if I want to pollute, I have to hand the government a permit for every ton of carbon.
Right. And if you don't have enough, you buy them. If you have too many, you sell them. It sounds like a pure, heavy cost burden on industry. You pollute, you pay.
A giant tax.
Exactly. But the math of this market is about to go totally rogue.
Because we get to the deadly tax cut nightmare. This is April 2006.
Yeah.
The conventional wisdom is that these regulations act like a tax that just chokes businesses. So when the cost of those carbon permits violently crashed in late April, those high-pollution companies should have celebrated a massive cost reduction.
But they didn't. Instead, their stock prices suffered an absolute bloodbath.
And, this makes zero sense. It's like a trucking company finding out diesel fuel is suddenly 50% cheaper, and their investors immediately panic and sell the stock.
Right.
Why would a drop in costs actively destroy a company's value?
To figure that out, we have to look at the tipping point, the fatal leak. Every financial disaster has one, and ours happened on April 25, 2006.
Right, the day the illusion shattered.
The EU accidentally leaked its very first batch of verified national-level carbon emission data.
And the data basically showed that everyone was wrong. The market realized there were way, way more permits floating around than actual pollution.
They had handed out too many tickets to the game.
So the scarcity was completely artificial. And the result? Just a catastrophic price drop.
In just 3 days, the price of a carbon permit collapsed from about 28 euros a ton down to 14 euros.
A clean 50% wipeout. I want you to picture a line graph completely falling off a cliff. Picture a sheer drop, no bounce, just gravity.
It was a bloodbath. But for these economists, it was the perfect natural experiment.
Right, because how do we prove that a drop in carbon prices actively destroyed corporate wealth? We look at the ultimate truth teller, the stock market.
They used an event study. They didn't rely on theoretical models. They put 600 European stocks, plus an extra 90 highly carbon-intensive stocks under an absolute microscope.
Specifically during that exact 3-day crash, April 26th to the 28th.
Right, and what's fascinating here is, well, we aren't just looking at random price fluctuations. A stock price isn't just a number.
Right. It's the market's collective belief about a company's entire future stream of profits.
Exactly. We are tracking exactly how investors instantly reprice the wealth of these companies. They saw the carbon crash, and they ruthlessly updated their spreadsheets.
So what did the spreadsheets actually say? Because the fatal mistake most people make is thinking environmental regulation only affects the cost column.
It is a massive error. The researchers lay out this mind-bending equation. A company's profit under cap and trade isn't just revenue minus costs. It's revenue plus the value of their free carbon assets minus production costs minus actual carbon emissions costs.
Okay, let me pause you there. Plus the value of their free carbon assets. This is the 3 dimensions of profit.
Exactly. Regulation reshapes 3 things simultaneously: how much you can charge your customers, the value of the free permits the government gave you, and your actual compliance costs.
So what does this all mean? It means if any of those 3 pillars wobble, the whole profit structure collapses.
The whole thing.
A drop in carbon prices isn't just a cost cut. It's a structural earthquake. It hits everything at once.
And the data from that earthquake does not lie, and the data is really ugly.
Let's talk about the industry-wide landslide, the actual numbers.
Over those 3 days, the entire broad European index, the Eurostock X 600, it dropped a very mild 0.45%. The overall economy barely blinked.
But then you look at the dirtiest industries, the absolute carnage.
Mining and oil and gas extraction saw their abnormal returns plummet by 2.73%.
Wow.
Utilities, the big power companies, crashed by 1.79%. Even real estate dropped 1.32%.
So the dirtiest, most energy-intensive industries, the exact ones that logically should have benefited the most from cheaper carbon, they took the hardest hits.
They bled market value, they got a massive tax cut, and the market punished them.
And this leads to what is honestly the most counterintuitive finding in the entire study. The ultimate face slap to common sense. The electricity paradox.
This part is wild.
Power companies are the poster children for carbon emissions. You'd think the dirtiest coal plants would suffer the most from carbon rules, and the clean nuclear and hydro plants would just reign supreme.
That's the logical assumption, yeah.
But here's the reality check. When carbon prices crashed, the absolute cleanest energy giants, hydro and nuclear companies like Fortum and Bushnell, their stocks absolutely imploded.
They dropped by 8.8% and 8.6%, almost a tenth of their corporate value, gone in 3 days.
And the contrast is insane. The ultra-dirty coal giants, RWE and Drax, they barely flinched in comparison. They dropped only 4.5% and 1.9%. Wait. The greener you were, the faster you died. How does a zero-emission hydro plant lose nearly 10% of its value because carbon got cheaper? They don't even use carbon.
Because of how the sausage of electricity pricing is made, it's all about the revenue effect.
Okay, break this down for me.
In European electricity markets, the price of power is set by a marginal pricing mechanism, meaning the price is set by the most expensive plant that has to run at any given moment to meet the grid's demand.
Which is usually a dirty coal or gas plant.
Exactly. So when carbon was incredibly expensive before the crash, those coal plants had huge costs, so they bid high. And that pushed the wholesale price of electricity through the roof for everyone.
So the price of power skyrockets. But what about the clean energy companies?
This is their unfair advantage. They didn't pay a single cent for carbon, right? Because they don't emit any.
Right.
But they got to sell their electricity at the wildly inflated carbon price market rate. They were making an absolute fortune, a massive windfall profit.
High carbon prices were literally printing money for clean energy.
Yeah.
So when the crash happened, when carbon prices fell, 50% electricity prices fell right along with them.
And the clean energy companies instantly lost all that extra revenue. They suffered 100% of the revenue loss, but they got 0% of the cost savings because they never bought permits to begin with.
That is brutal.
Right.
The market realized the free ride was over and just dumped the clean stocks.
Uh-huh.
But wait, why did the dirty coal plants survive the crash better than the clean ones? They lost that same electricity revenue, right?
Yes, their revenues dropped too. But remember the profit equation. Their actual massive carbon compliance costs also dropped by 50%.
Oh, wow. Pollution was their financial hedge.
Exactly. This raises a really important question. What is the safest asset in a volatile regulatory market? It turns out your dirty liabilities act as a natural umbrella.
A shock absorber.
Yes. The cost savings partially offset the revenue loss. The dirty companies had a built-in cushion that the clean companies didn't have.
So your dirtiness actually protected you from the market crash.
Yeah.
That is a total paradox.
And it gets even crazier when you look at how these companies got those carbon permits in the first place. The wealth illusion of free allocation.
Let's talk about this, because this is the biggest government handout you've probably never heard of.
To get the heavy industries to agree to this cap-and-trade system back in 2005, the EU literally gave away millions of carbon permits for free. It was called grandfathering.
And the truth is, these permits weren't just administrative paperwork. They weren't just permission slips. They were highly liquid, tradable financial assets worth tens of billions of dollars.
Exactly.
Okay, let's unpack this. The government basically printed billions of euros, handed them to the dirtiest industries overnight, and said, thanks for playing. High-pollution industries were suddenly rich with paper assets.
And how did the government decide who got how much free money? By looking at how dirty you already were.
Right, the 95% fatal correlation.
The study found a staggering 95% correlation, an R-squared of 0.96 between a company's historical emissions and the free permits they received.
Imagine a scatter plot chart, a straight 45-degree line. If you polluted a lot in the past, you got a massive pile of free assets today. If you were already clean, you got nothing.
The system practically perfectly rewarded past bad behavior with future financial assets. It's a masterpiece of unintended consequences.
Which set a massive trap for certain industries, the asset avalanche for surplus holders.
Right, because what happens when your corporate treasury is stuffed with a paper currency that suddenly loses half its value?
Who are the main victims of this?
Non-power industries. Places like paper manufacturing, ceramics, and metal production.
Why them?
Because the EU gave them way more permits than they actually needed to cover their real pollution. They were what we call net long on carbon.
They were hoarding free assets.
Exactly. And when April 25 hit, the price of their hoarded permits was chopped in half.
The emotion of that moment for those executives, I mean, these companies weren't even paying carbon costs out of pocket. They had plenty of free permits, yet they suffered massive wealth destruction simply because the free assets sitting on their balance sheets suddenly depreciated.
Their total net worth just evaporated.
And did the stock market actually figure out this complicated math in real time? Like, did investors really know about these hoarded permits?
Absolutely. The researchers ran an empirical test to prove it, the cost of asset impairment. The market was incredibly precise.
Give me the hard math on that.
They calculated exactly how much the market punished these net long companies. For every extra ton of free allocation a company had sitting around in surplus, its market value inexplicably dropped by exactly 31.5 euros during the crash.
That is terrifyingly accurate. The investors weren't guessing. They acted like ruthless accountants. They saw the value of the carbon assets crash, and they surgically extracted that exact value directly out of the company's stock prices.
In just 3 days.
So we have dirty hedges, clean energy wiping out, and hoarded assets blowing up. Let's look at the final pillar of profit, the consumer. Who actually pays for environmental regulation?
Spoiler, it's you. It's the consumer.
It's all about pricing power and pass-through. Explain pass-through for us.
It's a simple concept. If carbon costs go up, companies don't just eat the loss, they just raise the prices of their goods.
Right.
If they can pass 100% of the cost to the consumer, the regulation doesn't actually hurt their profits at all. The consumer absorbs the shock.
But here's the reversal. If costs go down, like in our April 2006 crash, they have competitors, so they have to lower their prices.
Exactly. If their pass-through rate was really high, a crash in carbon prices forces a sudden, severe crash in their product prices and therefore their revenue.
If we connect this to the bigger picture, companies with high pass-through loved expensive carbon. The regulation was making them rich because they got free permits but raised prices anyway. The crash ruined their party.
But not everyone had to lower their prices. There was one foolproof shield against the carbon market crash.
The natural defense of international trade.
The ultimate moat.
Let's talk about the divide here. Because if you sold goods strictly inside the EU, you were trapped in the local carbon price bubble.
Right. Your local competitors all lowered their prices, so you had to lower yours. But what if you were exposed to heavy international trade? What if you sold your steel or paper globally?
And your product prices are set by the global market, not the EU carbon market. A buyer in the U.S. doesn't care if European carbon is cheap today.
Exactly. So when the European carbon price collapsed, the heavily traded global companies barely saw their stock prices drop.
Because they didn't have to lower their global product prices. But wait, they still got to enjoy the cheaper local electricity costs in Europe?
Yes, they got the cost savings without the revenue hit.
They were playing on a global chessboard while everyone else was stuck playing local checkers. That is brilliant.
Yeah.
But, okay, as a skeptic, how do we prove this wasn't all just random market noise?
With hard, undeniable regressions. Empirical tests, too.
Walk us through the industry characteristics regression.
The researchers created 2 specific indexes. One for dirty output, which is how much carbon you physically emit, and one for dirty input, which is how much dirty electricity you have to buy to make your products. And the verdict is just deeply negative. The regression coefficients are undeniable. High dirty outputs and high dirty inputs were strongly mathematically correlated with abnormal stock price drops.
Meaning, the dirtier your supply chain, the harder the market punished you when the environmental tax dropped. Read that sentence again.
Right.
It makes no intuitive sense, but it is a mathematical fact. The market aggressively targeted dirty, energy-reliant companies.
Because the market knew those companies' inflated revenues were tied to the high carbon tax.
Well, what about the timescale? Someone's going to say, oh, it was just a 3-day panic, the market overreacted, investors got emotional, and it fixed itself a week later.
Wrong. The researchers ran a timescale robustness test. They didn't stop at 3 days. They widened the lens to a full 30-day window around the crash.
Well,
the results held completely firm. The negative impacts on dirty inputs and outputs remained statistically significant across the entire month.
so this wasn't a flash crash of emotion.
No. This was a permanent structural repricing of corporate wealth. The market digested the new reality of the environmental regulations and permanently cemented it into the stock values.
Wait, what if the whole world was just having a bad economic week in late April 2006?
Right.
We have to eliminate false positives.
Right, placebo tests. You need a control group.
So what did they do?
They ran the exact same event study methodology on the United States S&P 500 index during those exact same 3 days.
And the U.S. obviously didn't have a carbon market at the time.
Right. And the result? Flatline. 0 abnormal impacts on U.S. stocks.
Wow.
They also went back in time and checked European stocks in April 2004, a full year before the carbon market existed. Again, nothing. Total flatline.
This is the smoking gun. This completely eliminates the excuse of a broad market downturn. The massacre in the European markets was 100% caused by the changing rules of the carbon market.
Which brings us to the bigger truth of policymaking, the ultimate illusion of environmental policy.
This is where we have to reevaluate everything. Because the myth is that politicians give away free carbon permits because they genuinely believe regulations will crush corporate competitiveness. They think they have to protect these fragile industries.
But the reality, proven by this study, is that many industries are not fragile. They can easily pass more than 100% of carbon costs directly onto consumers.
Just so giving them billions in free permits doesn't protect them at all.
No, it gives them a massive, unearned windfall profit.
The outrage here is real. When you put a price on carbon and hand out free permits, the corporations aren't actually paying the price for their pollution. The end consumer is paying the price through higher bills. And the corporations are just quietly pocketing the free assets.
It completely reframes the whole system. A carbon trading system is not just an environmental lever.
No, it is a giant, state-backed asset distribution and rent-seeking machine.
It really is.
Which brings us to our final chapter, the historical loop. Because history is repeating itself right now, and you're paying for it.
Just look at the world today.
Exactly. Governments everywhere are pushing massive green subsidies, carbon border taxes, transition credits. Trillions of dollars are moving around under the banner of saving the environment.
And you have to ask, are we actually saving the planet?
Or are we just watching a new generation of corporations learn how to harvest windfall profits from the exact rules meant to restrict them? The mechanics of pass-through and asset impairment haven't changed. The next time you hear a politician announce a massive new environmental market, ask yourself, who is actually getting the free money?
It's a question you can't unsee once you know how the game is played.
Keep questioning, keep digging. Being well-informed means looking past the surface narrative of regulation equals cost and understanding the hidden mechanics of market wealth. We'll see you on the next deep dive.